Welcome to the deep dive. Grab your coffee because today we are diving deep into the financial heart of medtech. Boston Scientific's Q3 2025 earnings reports.
That's right.
This dense stack of sources just landed today, October 22nd, and we're here to give you the ultimate shortcut.
Yeah, our mission today is really to cut through the corporate jargon pretty quickly, synthesize what's driving the different segments, and, highlight those crucial strategic bets.
The clinical trial wins, the M&A.
Exactly. The stuff that's shaping BSX's future. And, the big takeaway right out of the gate, it was a spectacular quarter. They really blew past their guidance.
Okay, spectacular is great. Exceeding guidance is always good news. But to really get how spectacular, we have to tackle that classic medtech issue.
Right.
Acquisitions.
Acquisition noise.
The reported numbers look massive, but they're, inflated by recent buys.
Precisely. So we need to immediately focus on the difference between reported growth, operational growth, which strips out currency swings, and then the metric we really care about, organic growth.
That tells you how the core existing business is doing.
Right.
Without the boost from a shopping spree.
Exactly. And that's where the story gets really interesting this quarter.
Okay, let's get into the hard numbers then. Total reported net sales for Q3 2025.
Yeah.
They crossed the $5 billion mark. $5.065 billion.
Which is huge. And that reported growth figure, a stunning 20.3% year over year.
Wow, 20%.
Now, factor out currency, look at operational growth. It's still incredibly strong at 19.4%.
Still 19%.
But the crucial figure, the sort of internal engine number, is that organic net sales growth. And that hit positive 15.3% year over year.
15.3% organic.
Yeah.
Now, that is a number that makes you sit up, especially when you remember what the company guided for.
Oh, yeah. It wasn't just a beat. It was a substantial beat. BSX had guided for 12% to 14% organic growth.
So hitting 15.3%, what does that tell you?
It tells you their existing product portfolio is just really resonating. Across multiple markets globally, that's the core health signal we look for.
And that strength, that operational excellence, it flowed right down to the bottom line too, didn't it?
Absolutely. Earnings per share, the reported GAAP number jumped to $1.51. That's up quite a bit from 22 cents last year.
But we tend to focus on the adjusted EPS, right? The non-GAAP measure.
Yeah, us in the street. It filters out some of that non-recurring noise. And that adjusted EPS came in at 75 cents.
75 cents. And their guidance was?
So again, sailing right past the high end of the range, just across the board, more revenue, and they kept more of it as profit than expected.
Okay, let's talk margins then. Because growing sales is great, but turning those sales into efficient profit, that's what really drives value long term.
Yeah.
How did those adjusted margin metrics look?
They looked excellent. Really shows you the operational leverage they're getting. The adjusted gross margin expanded to 71.0%.
71%.
Yeah, up 60 basis points year over year. So for every $100 in sales, $71 covers the cost of goods. That's a fantastic profile for medical devices.
And the adjusted operating margin, I thought that climb was particularly interesting. 28.0%, up 80 basis points year over year. What signal are you getting from that?
I'm getting a signal that the products they're selling, especially those newer high-growth devices, are carrying really good margins, and that they're managing their internal costs effectively, too.
Right.
We look at that adjusted operating margin specifically because it pulls out some of those non-operational costs, right? Things like big amortization charges from recent acquisitions or those ongoing costs for implementing the EU MDR regulations.
Ah, the EU MDR headache.
Exactly.
Yeah.
So when you exclude those sorts of factors, the efficiency of their core operations looks really top tier.
The core business is clearly running lean. And their ability to turn that efficiency into actual cash, spendable money, that looked pretty impressive too. Free cash flow for the quarter was, what was it, $1.163 billion.
Stunning number. That's a 41% increase from the $822 million they generated in Q3 last year. So their liquidity is robust. And, their overall financial foundation looks solid too. The debt to adjusted EBITDA ratio is pretty manageable at 2.0x.
Meaning they still have plenty of firepower for future deals or investments.
Absolutely. So if margins are expanding like this, it usually means the fastest growing parts of the business must also be the most profitable ones.
Okay, so let's move from the big picture financials into the engine room. Where's the growth coming from?
Well, the cardiovascular segment is definitely the dominant force here. It's responsible for, 66% of total sales, over $3.3 billion just in Q3.
66%. That's 2/3 of the company.
And this whole segment achieved a massive 19.4% organic growth. But we have to start with the absolute star performer within cardio.
That would be electrophysiology, right? EP, I saw that number, 62.8% operational and organic growth. That sounds almost unbelievable for a major device segment.
It's wild, isn't it? And it is almost entirely down to one product. The FARAPULSE Pulsed Field Ablation, or PFA system.
PFA, that's the new tech for treating atrial fibrillation.
Exactly. It's the definition of a market disruptor. PFA systems are rapidly displacing the older radiofrequency ablation because they're faster, potentially safer, maybe more effective long-term. That 62.8% number, that's the sound of FARAPULSE just taking enormous market share.
Incredible momentum.
Yeah.
Okay, next up in cardio. Left atrial appendage closure. The WATCHMAN franchise. Still strong.
Very strong. Double-digit growth came in at plus 34.6% organic.
34%. Is that growth sustainable, though? Or are we getting close to saturation, at least in the U.S.?
That's the key question, isn't it? But the momentum right now is being fueled largely by what they call strong concomitant uptake in the U.S.
Concomitant, meaning doing it at the same time as another procedure.
Exactly. Surgeons are increasingly implanting the WATCHMAN device alongside other heart procedures like bypass surgery or valve replacements.
So that opens up a whole new patient group who wouldn't have gotten it as a standalone procedure before.
Precisely. It suggests the growth runway might still be quite long, actually.
Yeah. Okay, now, let's talk about where things looked a bit more challenging. Interventional cardiology therapies, or ICTX. That showed much more modest growth, only plus 2.9% organic. Seems a bit disappointing on the surface.
It does, until you realize what they were up against. The real story here is that strategic decision they made to discontinue the accurate valve systems globally.
Right, I remember that. How much revenue did that take out?
Those systems were generating about $50 million in sales per quarter last year.
$50 million a quarter. So to lose that much revenue and still post positive organic growth, that's actually pretty phenomenal.
It really is. It means the other parts of ICPX, especially the coronary therapies driven by things like the agent-to-drug-coated balloon, the DCB, and their imaging portfolio must have grown strongly enough to more than offset losing a whole product line.
Impressive recovery within the segment. Okay, finally in cardio, peripheral interventions, PI. Here, the acquisition noise gets loud again, right?
Yes, definitely. PI showed plus 15.8% operational growth. Looks great, but the organic number was only plus 6.3%.
Big difference, 15.8 versus 6.3.
That gap is where you really see the impact of recent acquisitions like Silk Road Medical and Intera. They bring in new revenue, boosting the reported and operational numbers.
But the underlying core PI growth.
The core growth, driven by existing products like Varithena for varicose veins and Ecos for clots, is solid but, not spectacular at 6.3%.
And there were regional differences here, too.
Yeah, important to note, US PI growth was strong, but that was partly offset by some lingering headwinds in China related to VBP volume-based procurement impacting their arterial business there.
Okay, let's shift gears to the MedSurg segment. Provides that stable foundation, about $1.7 billion in sales this quarter. And here, in urology, we see an even starker acquisition effect.
Yeah, this is where the split is most dramatic. Urology reported huge growth, plus 28.1%. Looks amazing.
28%.
But its organic growth rate was actually the lowest of all the main segments, landing at plus 5.4%.
Wow. So almost all of that reported growth came from
the Axonics acquisition. Remember, that deal closed last November. So the bulk of that 28.1% is just the contribution from Axonics sales hitting the books this year versus not being there last year.
Right. And remind us, why did BSX buy Axonics? What gap does it fill?
Axonics is a leader in sacral neuromodulation, SNM. Devices used to treat bladder and bowel dysfunction incontinence.
Okay.
So while the organic part of urology, mostly their stone management franchise, grew a healthy 5.4%, that big reported number really shows BSX's strategic bet to become dominant in that high-potential incontinence market via the Axonics deal.
Makes sense. Okay, what about endoscopy? That seemed much more straightforward.
Yeah, endoscopy looked like the picture of reliability. Solid plus 9.0% growth, both operational and organic.
9%. No acquisition noise, just good old-fashioned execution.
Classic MedSurg performance. High-quality, reliable growth. It's driven by market leadership in their anchor products, things like Mantises, Axiosa, Overstitch. When you see those core products posting double-digit growth within the segment, it signals they're really defending their competitive moat.
Good to see. And finally, neuromodulation, NM, drew plus 8.6% organic. Solid. But you mentioned the brain franchise within NM grew low double digits. Feels like it's punching above its weight.
It is, yeah. And the two things are directly linked. That low double-digit growth in the brain franchise was explicitly supported by a huge clinical success we should probably talk about next. Those 5-year Intrepid study results.
Ah, okay. We'll get to that. And the pain franchise.
Pain franchise also contributed well, grew high single digits, led by their Intercept procedure for certain types of chronic low back pain.
Okay, let's talk about that clinical validation then. Because in medtech, future revenue really depends on R&D success and proving your tech works long term. What were the big milestones this quarter on that front?
Well, that Parkinson's data publication was genuinely huge. The 5-year outcomes from the Intrepid study were published in JAMA Neurology. That's a top-tier journal.
And what did the study show?
It demonstrated sustained, long-term benefits from their deep brain stimulation, or DBS therapy. Benefits for motor function, quality of life in patients with moderate to advanced Parkinson's. That 5-year duration is really key. It gives clinicians immense confidence when they're choosing these high-value implanted devices.
Big win for the brain franchise. And sticking with growth drivers, more regulatory wins for that PFA system, FARAPULSE.
Absolutely. They got PMDA approval over in Japan for expanded labeling for FARAPULSE.
PMDA, that's the Japanese regulatory body.
That's right. And this approval now includes treating persistent atrial fibrillation. That's a broader, often more complex patient group than the initial approval, which was for paroxysmal AF.
So a significant market expansion opportunity in Japan for their fastest growing product.
Exactly. Huge potential there.
And they're still working to expand indications for established products too, right? I saw something about the AGENT DCB stance trial starting.
Yes, good catch. They commenced enrollment in that trial. It's designed to test their AGENT drug-coated balloon head-to-head against standard treatment, which is usually drug-eluting stents, but in previously untreated coronary lesions.
And not just for insert restenosis, but for new blockages.
Correct. If that trial is successful, it could significantly expand the addressable market for the AGENT DCB, really validating their earlier decision to acquire that technology.
Smart strategy. Okay, speaking of strategy and acquisitions, we saw 2 more deals announced or closed, focusing outside the core cardio space. Looked very targeted.
They did. The first one targets chronic pain. They announced an agreement to acquire Nalu Medical, Inc.
Nalu Medical, what do they do?
They develop a miniaturized system for peripheral nerve stimulation, or PNS. It's aimed at treating severe, intractable chronic pain. So this is a critical move, expanding their neuromodulation portfolio beyond spinal cord stimulation into this really large PNS market.
Interesting. And the second deal was different, focusing more on preventing post-op complications.
Exactly. A really interesting strategic angle. They completed an asset acquisition from Elutia, Inc. for 2 antibiotic-eluting envelopes. The Elupro Bio envelope and the Kangaroo envelope.
Antibiotic-eluting envelopes, what are they for?
They're designed to wrap around implanted devices like pacemakers and defibrillators. The envelope releases antibiotics over time to help prevent certain infections and complications right after surgery.
So it's moving towards proactive care, preventing problems before they start.
Precisely. It highlights a focus not just on the therapeutic device itself, but on improving patient outcomes by reducing complication rates. And critically, that also helps lower the overall cost of care for the healthcare system.
Okay, so looking ahead then, after such a strong Q3, what is BSX projecting for the rest of the year? Are they keeping up this ambitious pace?
They are, yeah. Management seems confident, projecting strong momentum right through the end of 2025. They're guiding for Q4 organic net sales growth to land somewhere between 11.0% and 13.0%.
11 to 13% organic for Q4. Still very strong. And putting all 4 quarters together, what's the updated full-year organic growth forecast?
They bumped it up slightly. They're now projecting full-year 2025 organic net sales growth will be approximately 15.5%.
15.5% organic for the full year. That's impressive consistency. And the bottom line, adjusted EPS guidance.
Also raised. They now expect FY 2025 adjusted EPS to land between $3.02 and $3.04. So yeah, the message is clear. The momentum from that internal engine, that organic growth, is expected to power them strongly through the end of the year. Hashtag tech outro.
Wow. This quarter really feels like a case study in successful execution, doesn't it? They managed to drive just spectacular internal innovation. FARAPULSE and WATCHMAN jump out while also strategically integrating those big buys like Exonics.
Right, and making those smaller but potentially very impactful targeted deals like Nalu for pain and Elutia for complication prevention. They're securing future growth pathways.
Yeah, covering all the bases.
And, you know, maybe that robust performance in neuromodulation and the strategy there is the provocative thought we should leave you, the listener, with today.
Okay.
Given that impressive 5-year sustained data on DBS for Parkinson's and the significant new investment in targeted pain relief with the Nalu acquisition, how rapidly do you think neuromodulation technologies might shift the standard of care for various chronic neurological conditions over the next, say, decade?
Interesting question. From niche to mainstream.
Potentially. And maybe also consider the implications of that Elutia deal moving beyond just the therapeutic device itself to actively preventing complications. How much of the medtech industry might shift focus towards preventing problems, not just treating them, and what broader impact could that have on healthcare costs down the road?
Fantastic questions to mull over. Thinking about the whole patient journey, not just the intervention. The foundation is clearly set at BSX, and the strategic roadmap seems pretty clear.
Looks that way.
Well, thank you for taking this deep dive with us today. Lots to digest. We'll catch you next time.